Hello, and welcome to the Road to Autonomy podcast. I am your host, Grayson Brulte. The Road to Autonomy podcast is brought to you in part by Florida Internet and Television. It's time to cut the tax on tech. Hello, and welcome to the Road to Autonomy. I am your host, Grayson Brulte. On today's episode, we're absolutely honored to have Jillian Slyfield, Digital Economy Practice Leader Aon. Welcome to the podcast, Jillian.
Hi, Grayson. Glad to be here.
Super excited to have you here. Jillian, for our listeners who might not be familiar with Aon, will you please kindly share a high-level overview of Aon and your role at the company?
Yeah, happy to. Thank you. Aon is a professional services firm, and we use data and analytics to shape the risk, retirement, and health solutions for our clients across approximately 120 countries, so all around the globe. I lead our digital economy practice, and within that practice, we focus on businesses that have either derived exclusively out of the digital world, or they have a change in their risk profile because of digital capabilities. And the way we approach our clients is to talk to them about what your strategic objectives are as an organization. And then I'll bring to you the tools of Aon, as we just described, that best help you accomplish those goals.
With a presence in 120 countries, that's awesome. And I think that's fancy. And it's also super cool. You have a really good insight and view into markets. In your opinion, what is the current state of the insurance markets?
Well, it makes me take a big, deep sigh because it is a hard market. It's the hardest market we've seen in 25 years. So our clients are looking at benchmarking reports and data to show them what they can expect at their upcoming renewals. And I often kind of either get an email back or a question back from clients that says, "Really?" And the answer is yeah. I mean, the markets are hardening anywhere from 25 to 40%, sometimes even more. We're delivering at times a 70% year over year increase in cost. So, what that means isn't just pricing, but it means there's reduced capacity. And capacity in the marketplace means that a carrier who previously might have offered $10 million of limit for a client is now offering $5. If they were offering $5 before, they're offering $2.5 now. So now we're approaching many more insurance companies to fill out a tower than we were before. It also means that there's a much slower underwriting process because carriers are becoming much more selective in what they're looking at. So it's taking us much longer to get to the final outcome than it did before, and we have to be much more prepared. And when I say we, I do mean Aon, but I also mean our clients and anyone else who's participating in the renewal, that this is it's really a focus on collaboration and partnership to get things done. It also increases the need for additional data and insights around the data, particularly in my space in digital economy, where we have emerging business models. And so it's easy for an underwriter to make assumptions that might not fit the business model because they're learning it too. So we need to make sure that we're packing as many insights around what we're providing to underwriters as possible.
There's a genuine consensus where underwriters are looking for data, but the 25% to 40% stands out to me. If you're a startup and you're growing really fast, that could have a really big impact on your cash flow. How are your clients preparing for that increase?
Yeah, that's a great question, Grayson. So I think the best thing that we can do in the industry is just that, is prepare our clients so that they can make a plan around that change in cost and what it means for them as an organization. In some cases, it means they buy less insurance because they've got a budget and, they've got to buy the insurance that's available within that budget. In other cases, it means that they have either a thinner profit margin or a longer path to profitability than they had before, and they need to take that into consideration too. But we work very closely with our clients to say, okay, let's talk about the budget. We see the impact that these huge increases are having, and let's make sure that there's a value around what you're buying and that you're buying insurance at the right level. So maybe it means you're increasing your retentions or your deductibles, as an example, because you're more worried about the catastrophic risk than you are about the lower level risk, or what we call the frequency. So we just want to make sure that if you've got a limited budget in this incredibly difficult market, that you're deploying that budget in the best possible way to protect your company.
Do risk managers inside these companies worry about being underinsured due to the current state of the world? Like there's something that might pop up, but wait a second, I don't really have the budget for that. Does underinsured ever come up in any of these conversations as a fear from a risk manager?
All the time. And I know that the title of this podcast is The Road to Autonomy. So if you take autonomous vehicles as an example, there are many autonomous vehicle companies that would like to buy more insurance. They would like to have higher limits. They're just not commercially available right now. So that is something as an organization that we're trying to help carriers understand. And I know we'll talk about this a little later in the conversation, but getting people comfortable with that so that our clients have the capacity that they need to run their businesses.
What's causing these very large increases? Is it the current state of the world, the economic uncertainty, the political uncertainty, not just in the United States, but there's political uncertainty in multiple regions across the world? Is that playing into the markets? Is this kind of like the perfect storm has come together to increase these rates?
That's exactly it. It's hard to point to any one event. In fact, I think you could look back over the last couple of years and see some very significant weather-related losses, terrorism-related losses, and they all impact the global insurance markets. And when you see, a tightening of the insurance market like we are now, that really isn't because of any one thing. It's because of all these different factors that you brought up. It might be a change in regulation to some degree. It is definitely loss patterns that we've seen historically. It might be a change in the political stability of a certain region and how that's impacting insurance carriers. It all flows up to the reinsurance markets, very data driven underwriting in that space. But yes, everything that you mentioned is putting pressure on the current situation. And it's, frankly, very hard to see when that's going to have any kind of relief.
When we look to 2021, the United States has been through a presidential election, has been through a lot of elections in the Senate. The UK is looking more stability around Brexit. Do you kind of see the insurance markets stabilizing more once these factors are a known commodity as we go into 2021?
Boy, Grayson, if I had that crystal ball, I would not be the digital economy leader of Aon. I would be ruling the world. It's hard to say, but certainly I think as there's certainty in any one of the things you said, whether it's monetary policy, certain elections that are very impactful, that absolutely contributes in a positive way to the way that the insurance markets respond. Given the just enormous increase in year-over-year pricing right now, it's hard to see the exact end to that. I don't think it's going to be a November 3rd date, but those things do help to stabilize.
Well, stabilization's good, and I have a small daughter, and you get in a routine, and you go to school at 8:30, and you get picked up at 2:30. And so I could see from a risk manager's perspective, getting into a routine and understanding is really healthy. But when I look at the capital markets here in the United States, seen a lot of interesting things that really have not really made sense. And one of the trends that has emerged in 2020 were SPACs. And SPACs in the United States have raised $51.3 billion this year as compared to $111.6 billion raised in initial public offerings. So you take two different ways to go public. How is the insurance different for a company merging with a SPAC as compared to traditional IPO? Are the underwriters looking at a SPAC as a more risky insurance where the traditional IPO you have to go through in the old days the roadshow, which now is a virtual roadshow, and you get a lot more information? Is that weighing in any of that risk factors for underwriters?
We actually, for anyone who's interested, we did a webinar on SPACs recently. If you want to deep dive into this, there's an Aon webinar for that. But, interestingly, the markets see SPACs as being less risky than a traditional IPO, which can be very positive, of course, for someone going through that. And the biggest risk issue here is the directors and officers liability, or the D&O. I won't pretend to be a D&O expert, but I do know that there's certain considerations to take into place when you're approaching a SPAC, or have that in mind. One of the things that comes to mind is you have a much shorter timeline between agreement to the SPAC and its conclusion. And so you've got to be able to work much more quickly. So your, what we call kind of your D&O roadshow, as an example, is a much faster process, much more efficient than it would be in a traditional IPO. So you've got to cram in a lot more information, more relationship building with the markets in a faster timeline. But certainly your insurer selection is really important. So there are certain carriers that have an appetite for this kind of business, and they also specialize in certain industries. So they might specialize in manufacturing, they might specialize in automotive, and you want to make sure that you're selecting a carrier that understands your business model. SPACs often require a multi-year policy, so there are some carriers comfortable with that, some that are not. Many of the SPACs are domiciled outside of the United States. So if that's the case, then you need to have a carrier that is also able to respond to the coverage as necessary. You also are looking at pre-agreed coverage considerations in the event that something goes awry with the SPAC or the relationship, and that you have some certainty in coverage in those examples. And I would say, lastly, around this, you're looking at some analytics and benchmarking. So you want to make sure that you're getting not only the best coverage, but the best pricing, and that you're looking ahead to the market. And when there's as much volatility in the market as there is today, this is no small feat.
We've seen trends in the market where the reverse merger with the SPAC is announced, the stock goes up dramatically, and then it starts to slow decline. And so, as a company that's raising the SPAC money, or as they use on the term on Wall Street, going hunting for a company to merge with, is that where Aon works hand in hand with the SPAC? Say, okay, we're going to buy Acme company and merge with it. Is that where Aon comes in to help say, okay, these are the carriers that would be interested in insuring this? So you work hand in hand with those investment vehicles?
Yeah, that's right. That's right. So we talk to all parties involved and make sure that they're prepared for the transaction given their perspective, whichever role in the SPAC that you're playing. But if you're talking about kind of going through it and how it looks compared to a traditional IPO, the liabilities inherent to public companies apply to SPACs too. So you're going to see things like, if you're looking at claims activity as an example, it's going to be around conflicts of interest or reporting and record keeping violations, fraudulent interstate transactions, things of that nature. Same types of things that we see with traditional publicly traded companies. And that's where a team like Aon gets very assertively involved with our clients, both from a claims perspective. You get to know your claims advisor in advance so that they can help you and your broker shape the wording of your policy. Again, having that contract certainty so that you know what will happen and how your policy will respond in the event that a claim occurs or the relationship dissolves for some reason during the transaction.
Is it a fair statement to say that Aon rolls their sleeves up and works hand in hand with their client to ensure that they have the right coverage and something might have not been mixed? And a common thing that, and the homeowners are well aware of it, you have wind insurance and flood insurance, and sometimes one is overlooked and you have that flood. And you're like, well, I had the wind, but it wasn't caused by the flood. You help avoid all those little nitty gritty things, I'm assuming, for your clients so they don't have that situation.
Yeah, thanks for pointing that out. Absolutely. We really try to make as many, if you will, of like the if then statements. If this happens, then here's how we'll respond. Try to think of as many scenarios in advance to make sure that you're protected. And then, claims occur all the time. And that's why the insurance is there. That's why you've got strong advisors like Aon behind you, so that should something arise, you get the best counsel possible. And that might be from attorneys that we have that work here at Aon. I'm not there to provide legal advice to you, but to help you understand the insurance contracts. They're all contracts in place, and to make sure that you're getting the most benefit out of the insurance policy that was put in place.
This has been really, really insightful for SPACs. So thank you for your insight on SPACs and the insurance risk. And I want to pivot here for a minute to the digital economy, which you are the practice leader of. And I want to read you a September 2020 report from Carlyle titled "When the Future Arrives Early." In the report, the firm stated the most consequential innovation of the past 20 years may not be a specific application or device, but the way technology facilitated the emergence of new business models. Taxi companies arose that did not own cars or employ drivers. Businesses enter the hospitality space with no physical assets or employee overhead. And media companies no longer require broadcast licenses, network infrastructure, or cable carriage to reach millions of subscribers. How are you working with underwriters to properly insure asset-light companies? As this report from Carlyle clearly stated, you have companies like Airbnb that are operating a hospitality company without owning a hotel. Was that when that first started? Was that a foreign concept to an underwriter when they went to look at data or looked at how do you manage and underwrite this risk?
Yes, no question. And to underscore that point, that's exactly why we started this practice, the digital economy practice, is because the risk issues, the method of underwriting, even the data that's used for underwriting, as well as the service necessary after the policies are in place, is really different than it is in legacy businesses. And so, for Aon to invest in a practice kind of underscores for you how important and differentiated that is. And so for this, one of the things that's interesting, I just kind of thinking about that, when the future arrives early, I saw a McKinsey study that said just because of the pandemic alone, progressed digital adoption by consumers of new technology by about 5 years. So I think some of us might not have ever gotten our groceries delivered before by, an Instacart or Postmates, et cetera, but now that's happening. And the pie has gotten bigger to the participants in that. So when I look ahead at, how are we working with underwriters? We start by looking at the three parties to every transaction. So in Aon's traditional business, it's our job to protect the enterprise. And it still is our job to protect the enterprise with platform-enabled businesses. But we also have to think of, you used Airbnb as an example, we also have to think of the guest and the host who put their home on the platform, who's staying in the home. It's not just protecting Airbnb. If you're thinking about a rideshare company, it's the rideshare organization, but it's also the driver and the rider. So first and foremost, we're often looking for three solutions or one solution that can protect all three parties to the transaction. So that's a different view, and it requires both a commercial view of insurance and a personal lines knowledge and expertise to bring those two together into one coordinated effort. We also have to recognize that the needs are different at different stages of a company. So how we underwrite a startup business is going to look different than how we underwrite when they're kind of stretching and growing in that fast growth stage. Again, what they look like when they're mature. So when they're 10 years in the business, to your point about Airbnb, did it look different to the underwriters then? Of course. And making sure that they understood the business model is critical. But now when you say Airbnb, and you use it as an example today, because we all know what it is, right? It's a good example because it's become commonplace. And so the conversation has changed too. But one of the things that we work on too is building, we've talked a lot about capacity so far, but building capacity in the marketplace. It is not in an insurance company's best interest to work on unknown and emerging tech business. They would say, and you can imagine, they're fairly risk adverse by nature. And so, when you bring something new to them, it is the underwriter's job, yes, to write new business, but it's also to protect their company. And if they can't understand the business model or how to underwrite the risk, they'll protect their company by saying no. And so it's our job to help underwriters both understand the business models of the companies in this space, but also to help them understand how we have more data around every part of the transaction in the digital world than we ever had in legacy business. So let's underwrite to that new data instead of thinking about underwriting these new and emerging tech companies using old underwriting tools.
When the underwriters look to understand a business model, I go back to the old Google saying from way back when of eat your own dog food. Do the underwriters staying on the Airbnb team, do they stay in an Airbnb, or do they go for a ride in an Uber or a ride in a Lyft, or if they're insuring a self-driving car, go for a ride in there to really understand the business, to get their hands on it?
Yeah. So I think one of the things that's really exciting is they want to. And so, they really want to partner with these companies. We had, as an example, a electric scooter company that's a global company, and we brought a group of underwriters together to ride electric scooters in a warehouse. So because they'd never seen them before, they'd never touched them, they never rode one, and so relating to the product was really difficult. I have another carrier who requires that all of their underwriters participate in a platform from the supply side. So it means they have to drive for Uber. They have to put their house on Airbnb. So they have to participate from the giver of the service perspective, and they have to participate from the consumer of the service perspective before underwriting the risk. Just gives them a whole different perspective on what's happening during these transactions.
You bring up a really valid point about the giver of the service. And I want to ask you two questions on that. So if you're on the underwriting team and you put your home on Airbnb and an item of value goes missing, who's responsible for that? And if you drive for Uber and let's say somebody, your back seat gets a big scratch on it, who's responsible for that? Is that they're looking for these nuanced things that happen and could happen every day that they might not have thought when they're going through the underwriting process?
Yeah, I think some of it is the physical damage of any kind of property, whether it's a home or a car. It's probably more focused, maybe a little bit more physical damage to a house, certainly, but it's really around liability risk. I mean, I think that's where we find the biggest exposure load is in the liability is damage to someone's home. So that's a third party damage, and that's a liability, or damage to a car. Interactions between two humans can always get complicated. They might both start with the best of intentions. And so depending on what the platform is, and not just as an example, rideshare versus home share, but even across the rideshare companies, across the home share entities, how they treat these different circumstances can be very different, and usually is pretty reflective of the culture that they have and who they want to be to both their guests and their hosts, the riders and the drivers, as an example.
For a carrier or an underwriter working with Airbnb, are there some rules where, for example, they will not insure a homeowner that has a pool? Is there things like that? Does it get that nitty gritty down into the nuances of it?
Yeah, I can't speak to their specific program because as a client, we want to respect the non-disclosure agreements that we have in place around how they handle certain risk issues. But absolutely there are standards for any kind of platform enabled business that need to be upheld in order for the underwriter to feel comfortable, whether that's, things like age of a driver driving a vehicle or the type of home that's offered or the cleanliness and maintenance of a certain location. So there's definitely a set standard, and yes, it can be as detailed as the example that you gave.
Staying on the theme of the age of the driver, anybody that has an Apple TV or a regular TV sees Progressive commercials on all the time, and the really nice lady and she does her Progressive thing. And during an October 7th interview with David Rubenstein, the host of the David Rubenstein Show from Peer to Peer Conversations, Trisha Griffith, CEO of Progressive, the one with the very famous commercials, which also happens to be one of America's largest auto insurers, stated the following when asked about the autonomous vehicle's impact on Progressive business. I am preparing for a possible smaller insurance industry. And she's now diversifying into new lines of business, such as home insurance. Is this a trend that you're seeing in the insurance industry? If a large percentage of your business comes from auto, when we go into new forms of mobility, that they think that line, it's not going to go away, but it'll become smaller, and they're looking to diversify the revenue streams?
Definitely. I mean, there's a shrinking pie. I think to keep in mind too, though, even as we talk about an autonomous future, and it's, some of that future is already here, although obviously we're not fully autonomous, but it's an evolution. So I don't see it as today we have X premium, tomorrow we have 0.5X premium. I think what you'll see is it's, this gradual decline in premium associated with auto liability, specifically by human drivers. So what we believe is true is that if you think of it as a pie, that pie of auto liability, that exposure pie will be reduced. When you're looking at the future for autonomy, autonomous vehicles don't get distracted. That's the number one reason for auto claims. They don't get tired, right? So we're anticipating that when we have fully engaged autonomous vehicle drivers that are not texting and that are not sleepy and that are not preoccupied, that we're going to have less claims and therefore less need for insurance coverage. So yes, we definitely see that pie shrinking substantially. The other thing that I think is kind of interesting is, and this is another chain maybe for another day, but when we look at blockchain technology and the efficiencies that it can bring to the insurance industry, you're talking about billions and billions of dollars that can be impacted through just efficiencies in adjudicating claims, gathering data, et cetera. And so I anticipate that we'll see a bit of the shrinking pie due to new technologies as well.
When you look at new technologies, and I'm in insurance, I'm a CEO of an insurance company, you're doing your forecasting, you're preparing for X amount of miles to be driven, X amount of claims to be paid. Like there's a whole data set I'm sure you're going through. And during COVID, my insurance company, I got 2 dividends back because they said that they did not have to pay out because the vehicle miles traveled went down. Is that something that we will see the insurance executives prepare for, a fully human driving, and then as this technology goes in, without taking that risk, they'll give the dividend back to their customers? This way they're protecting their risk?
That's an interesting question. I don't know if that'll be how it'll work. If it'll work from a dividend perspective, my perspective is that when I'm looking at insurance companies, we're starting to see more and more carriers price on a per mile basis, which I think eliminates some of that need for charging one price, giving back another price, and kind of that more erratic behavior that you describe. I mean, it feels good to get that money back if you're
You're happy.
right, and you got it in the mail, and it showed up in your email one day that it was credited to your account. But from a carrier perspective, that's fairly volatile. So usage-based insurance has been used now for about 10 years for different kinds of policies, and really started with the auto industry. And in usage-based insurance, it's a pay per something, pay per mile, pay per minute, pay per task, some kind of pay per transaction. And when that's the case, then the liability will follow the situation, right? So as the liability to your description and as autonomous vehicles become, a computer driving the car instead of you, then the pay per transaction will fall upon the manufacturer and not upon you. But if you're driving, if you're the human driver in the car, in a more traditional sense, then whatever your per mile rate, as an example, will apply to you and will ebb and flow with your participation as a driver.
I'm riding in an autonomous vehicle. There's Waymo, for example, is operating in Chandler, and they do not have a safety driver currently with the Waymo One program. Who's paying the insurance? Am I paying the insurance part of my fee to go from point A to point B? So instead of $7, it's $9 with the insurance. Who's paying that insurance?
Well, I always think I'm a wary client, right? But I always think the ultimate customer is who pays. So, the cost will ultimately be borne by the consumer, of course, just like when you buy your car. Today, as a human driver, you purchase a vehicle and whatever it costs them to manufacture that car, plus their insurance costs, et cetera, they're all baked into that purchase price. So I think the ultimate customer will be the one who bears it through the cost of the service being provided. Having said that, I don't think it's an insurance policy necessarily that the customer buys. I think what most industry analysts would say is that it's the manufacturer. And it will rest on them. The challenge to that is that's easy to say, and you can say, okay, that makes sense. But pull that apart for just a minute. What you see now is there are autonomous vehicles that are being built from the ground up by one company. All the technology, the auto itself, that's all one company. A lot of autonomous vehicles are one company that builds the vehicle, and they're often OEMs with brand names you would recognize. And then they either partner or buy technology from third parties to put on their vehicles. So you may see, I don't even know, a dozen different participants in the word manufacturer, right? It's the vehicle manufacturer, it's the LiDAR manufacturer, et cetera. So then when you say, okay, the insurance is borne by the manufacturer, it's actually a fairly complicated answer to, it sounds like a simple answer, and you peel it back a little bit, it's fairly complicated.
And you know me well enough. I got to make this more complicated when I ask. Will I, as a passenger, carry my own form of liability and insurance?
That'll be interesting to see. My perspective is that back to your quote from the woman from Progressive, I'm not sure if this is what she's thinking about in that, but I could see a day when we extend the current types of policies that we buy already to this new environment. So take your homeowner's policy as an example. It extends to a lot of your activities outside of your own home and to your goods and parcels, whether it's lost and stolen items, et cetera. So I don't think this world is quite what most carriers envisioned when they made a homeowner's policy. And in fact, sometimes homeowners will exclude certain things related to the new economy. However, it's a market opportunity, and it's a very well-suited new product line or expansion of the coverage, whether it's a homeowner's policy or renter's policy, et cetera, to do that.
And to me, it's someone who has, I would call, tier one household name insurance, that it seems like it'd be a highly profitable market, because my wife likes to say, you pay it so you can sleep at night. And so I'm sure that there's a pretty healthy market for that, and it can have some healthy revenues for the insurance companies. We focused a lot just now on the passenger side of autonomy, and I want to flip here for a minute to the commercial side. Is there a difference of insuring a autonomous vehicle that's driving with human passengers versus a self-driving truck that's carrying cargo? Are those insured completely differently, or is it very similar?
Similar and different. So there's definitely similarities between the way that the autonomous vehicle technology works and the way that underwriters evaluate the exposure. Having said that, there's much greater bodily injury exposure from a truck. If I think about kind of a semi truck or a truck that's used in logistics versus two passenger, maybe one passenger and one driver in a car today, or even an autonomous vehicle, computer-driven car with one or two passengers in it, probably has a lot less bodily injury exposure potential than a semi truck. So they do look at that. Plus, when you're looking at autonomous trucks, you've got to both access the trucking market and the autonomous vehicle market and have them come together. And trucking is highly regulated, so it's an additional layer of complication for that. Having said that, it is a growing part of the industry. There are already numerous autonomous trucks on the roads today, some that are using platooning to move goods from one side of the country to the other. So it's not a foreign concept to underwriters, but there is certainly an exposure there that needs to be recognized.
What about autonomous delivery bots? How do the underwriters look at those? And so now we've got three different types of form factors. We've got the small little bot, We've got the passenger car and we got the truck. And so if I'm an underwriter, as you're looking at this, trying to understand all these different form factors.
Yeah, one of the issues with the delivery bots is actually the what we call the marine coverage, which has nothing to do with water, despite the name. But how do you ensure the bot itself is an issue for underwriters. But the liability for a bot, typically the bots don't move very quickly, so they're not typically running anyone over. They also tend to have sort of innocuous goods in them. One is being used right now to deliver pizzas. Last I checked, most pizzas didn't hurt very many people. So you've got kind of an innocuous machine delivering innocuous goods to households in fairly low quantities. And so it tends to be a somewhat low exposure load. Having said that, I think that'll change over time. There's a lot of experiments around bots to deliver medication into difficult places. There's bots can get to places humans can't get. It can safely deliver goods where humans might not be able to safely deliver goods. So like a lot of autonomous vehicle new technologies, I think that it will evolve over time. We're seeing some bots in places where there's significant consumer acceptance of the technology and other places where consumers think it's still a little weird. And so the consumer confidence in the technology itself is low, and therefore kind of how we can pack insurance around that is also in question.
Is there different insurance rates for the bot that goes on a sidewalk versus the bot that travels in a road up to 25 miles an hour?
Oh, definitely. I mean, depending on how the bot is classified, so that's a very good point. If it's a sidewalk bot, as you described, there's also bots that are transported in part aerially. So they might be dropped off in different locations, and then they have a kind of a sidewalk last mile, if you will. It's probably not a mile, but the last couple of blocks, if you will. So definitely. And this goes back to, we talked earlier about usage-based insurance, which is, what's the best way to ensure these so that we get very efficient, might not be low pricing, but efficient pricing. And we can look at each point in the transaction and price it appropriately.
And that was a really great way to wrap this up and connect this conversation. And as we look to wrap this up, I'd like to ask you this one last question. What impact will mobility and innovation have on the broader insurance industry over the next 25 years?
I think it's so exciting. I have so much fun working on mobility. And of course, insurance is my home base. So mobility has challenged us all in the insurance industry to get better at what we do. As I said, it was mobility that provided the first usage-based insurance policy. We've seen mobility change so much over the last few years. And in some ways, the insurance industry has had to catch up. And in some ways, we've led those discussions. So I do think it increases digital enablement. So there's a lot of opportunities to have both usage-based insurance that fits the mobility transaction, but it can also be a pivot point to consumers for other needs that they have. And those can be a variety of industries, whether it's healthcare, retail, et cetera. So there's some really interesting intersections between mobility and insurance around digital enablement. There's also, as we talked about before, kind of an increase in consumer acceptance of new technology. There's also, there's always an assumption that insurance is included in every transaction. We all think we're covered, right? It's part of how we build trust and confidence in new technology. And so that raises the bar to us in the insurance industry to say, okay, if you think you're covered on that scooter or you think you're covered in that bot, we better make sure that you really are. So insurance included in every transaction. And then, that last piece that you touched on before is that evolution of autonomous vehicle liability and what that means for consumers. And when I look at autonomous vehicles, I really look at it across, when will this proliferation happen and therefore have this big impact on the insurance marketplace? It's happening, but it's not overwhelming right now. And to me, it's kind of consumer confidence. It's sufficient infrastructure, which we really struggle with in the United States, and thoughtful legislation. And when those three things come together, you'll see this technology flourish, and the insurance industry is there to lead the way.
And you're right about getting all the pieces to come together, as you said, with the insurance company pieces coming together. And it's really great. And if you're a startup founder or CEO and you have an innovative company with extremely complex insurance needs, please call Jillian. I can tell you, as you heard from this conversation, she's wonderful, but from a personal level, she's an incredible person with a great insight, and her and the team at Aon can really do a wonderful job to help you ensure that you are not underinsured and that your company can thrive. And as my wife says, you can sleep at night.
Thank you, Grayson.
So the future is bright, the future is autonomous, the future is insurable. And Jillian, thank you so much for taking the time to come on the Road to Autonomy and share your wonderful insights into the insurance market with us.
Oh, thank you for the invitation.
You're welcome. Thanks again. Thank you for listening to the Road to Autonomy podcast. If you've enjoyed listening, please rate, review, and subscribe on your favorite podcast platform. Want to get in touch? Follow us on Twitter at Road to Autonomy or email podcast@brulteco.com. The Road to Autonomy is produced by Brulte & Company. The views and opinions expressed on the Road to Autonomy podcast do not necessarily reflect the views and opinions of Brulte & Company. The content discussed in this podcast is for informational purposes only and should not be taken as legal, tax, investment, or business advice.